Today, we're bringing back RedFin's senior economist Chen Zhao to talk about why investor home purchases fell 6% in the second quarter and what opportunities investors may see for the rest of 2025. I'm Kathy Fettke, and welcome to the Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Today, Chen and I are going to discuss why investor activity plummeted, what asset classes are seeing the steepest decline, and which markets investors are staying away from. Make sure to stick to the end because Chen and I will discuss what we think will happen in the next Fed meeting and if rates will drop, and if so, by how much. And if you want more cash flow and you want properties with a good chance of appreciation because they're located in fast-growing markets with job growth and population growth and infrastructure growth, come join us at our upcoming event October 11th in Manhattan Beach. We'll have property teams there with property management in place. They offer brand new properties or fully renovated to help make investing turnkey for busy professionals. And we'll have experts there talking about how to do a 1031 exchange, how to save money on taxes, and how to get asset protection. Plus, I'll be there to share information about our new fund, our multifamily rental fund, where we're buying A and B class apartments, again, in the fastest growing secondary markets. I really look forward to seeing you there. You can find out more at realwealth.com/1031. Again, that's realwealth.com/1031. Chen, welcome back to the Real Wealth Show.
Thanks so much for having me today.
Your team recently released a report, U.S. investor home purchases. What did investor activity look like in the second quarter?
What we saw is that investor activity has declined in the second quarter of 2025, while the share of purchases that are going to investors has stayed pretty flat. A number of homes that investors are purchasing has been falling, and that level is at the lowest since 2020. So what's happening is that investor activity is really just reflecting what is going on in the broader housing market, which has been very sluggish up until now this year.
All right. Even though purchases fell, investor market share held steady?
Yes, that's right. So the share of homes that is going to investors is around 17% right now, and that is pretty consistent with what we've seen over the last few years.
Do you happen to know what the highest it's been, or in recent years at least?
So the highest we've seen is around 20% I think around 21% in 2022. And that is really in the aftermath of pandemic, where we saw investors really diving into the market.
Yeah, and I remember a lot of panic, a lot of headlines. Oh my gosh, investor activity is basically eating up all the inventory out there, but it really wasn't that much higher than where it is today. Or is that 3-4% difference a lot bigger than I think it is?
I mean, I don't think it was ever really the case that investors were like buying up all of the homes. But
Yeah.
it is true that during the pandemic, when rates got very, very low and you saw that rents were increasing very quickly, there was a boom in short-term rentals, that investors did become relatively more active in the housing market.
So then today, if the investor activity is down, does that mean regular homeowners and home buyer activity is up?
I mean, in a relative sense, not really, because it seems like the share is actually pretty flat right now. So what's really happening is that in the housing market as a whole, everyone is just not buying a lot of homes. So whether that
Right.
individuals or investors, there's just not a lot of activity happening in the housing market right now.
Yeah, I mean, just anecdotally, we're seeing a bit of a slowdown in activity at Real Wealth, but still a lot of investors are buying, at least within our network. But it's slower than it's been, certainly, compared to 2021 when it was a frenzy. All right, so what asset classes saw the largest decline in investor activity?
So what we're seeing is that right now, investors are doing the lease purchases in the condo market. So we're also seeing the lease investor activity in places like Florida, for example. So this is actually also, again, nearing what we're seeing from individual homeowners. So right now, if you're looking at the housing market as a whole, really the condo market and places like Florida, which also happen to have a lot of condos. So this is really no accident that, these two kind of overlap. That is really where the epicenter of the weakness in the housing market is. So it's not super surprising that you would see that individuals are buying less in Florida in the condos when you're seeing the same thing in investors, right? Because investors are looking at what is going on in terms of like returns to their investment. And right now, if you were to buy in a place like Florida, you would see that there's not a lot of return on investment, at least in the near term, because prices are falling in a lot of places in Florida right now, not necessarily all of the metros, but in many of the metros, for example. And you're also seeing very weak demand in those places. So it's not really surprising that you're seeing a mirroring of the two.
Well, when it comes to condos in Florida, do you think the HOA fees or high potential assessments would be a factor?
Yes. So what we're seeing in Florida is that there are two things that are happening, right? So it is both the case that there's a lot of supply and there's also less demand at the same time. So the supply side is pretty easy to see, right? So you look at inventory, you can see that inventory in Florida is really piling up. It is also in other Sunbelt places as well, but like, it's definitely like concentrated in Florida. On the demand side, this is a little bit harder to measure, but so Redfin introduced a new metric a while ago where we're able to estimate the number of active buyers that are in a market. So we do this by looking at what is happening in terms of supply and what's happening in terms of like results. So how many actual purchases there are. And then we have some Redfin proprietary data on how long it takes people to successfully go from tours to a purchase. So using that, we have a model that allows us to estimate how many buyers there are in the market. So when we look at that, both nationally and then in a place like Florida, what we see is that demand is slowing down across the country on average. But in a place like Florida, you also see a real slowdown in demand that's been happening over the last few years. So then you have to start asking yourself, well, what is driving that slowdown in demand? And I think a lot of that is what you're pointing out, which is that it's not just about the cost of buying a home in terms of mortgage rates or like the cost of the house itself, but it's like these other costs. It's the insurance, it's the HOA fees, that it's very hard to have data on things like insurance, or even HOA fees are harder to measure than just home prices. But from what we can see, we do know that those costs are really increasing the cost of home ownership, and it is increasing the cost for investors as well. So that seems to be a big part of why the demand is coming down.
Yeah, I mean, on the flip side, when there's more inventory, you can really negotiate some incredible deals. We had an investor at RealWealth with a 1031 exchange, and she was able to buy quite a lot of property at big discounts in Florida. The rental demand is so strong, so that's working out. But again, it just depends on what you buy. A newer property in Florida is going to have lower insurance than obviously an older one in a hurricane-prone zone. So are there specific markets in Florida? Are you aware of specific markets in Florida where it's more effective than other parts?
Yeah, so what we do see is that the coastal parts right now are especially affected. And that's, I think, exactly what you would expect if you think that a large part of the story is being driven by climate related concerns, right? So those are the places where you think that a lot of those costs are also increasing. But it is also the case that, some of the decline in demand doesn't necessarily have to be tied to actual realized increases in insurance costs or HOA or anything like that, but it could just be fears about the future, right? So that sentiment, I think, is especially strong for people who are looking in coastal regions, and that is reflected in our data as well.
Yeah, that makes a lot of sense. We stay out of flood zones for sure. All right. Well, if those are the markets where you're seeing less activity, where are you potentially seeing more investor activity?
Yeah, so we're seeing more investor activity right now on the West Coast. So the strongest market that we're seeing is in Seattle, actually, but we're also seeing some of it in California as well. These markets, sort of like these tech heavy markets, have had sort of a different ebb and flow over the last few years compared to the rest of the country. There's obviously a lot of volatility in the tech industry, that we're also seeing that is partly being mirrored, I think, in the housing market. And then you have to layer on top of that the dynamics from COVID itself for some of these, markets like, the Bay Area, where they were already very expensive before the pandemic, but then, didn't really see the price appreciation during the pandemic that other places did. So, it's kind of a different pattern in those markets. And then the other markets that I would highlight are the Midwest and also the Northeast. Those are the places that are still remaining very resilient right now because they don't have that big increase in supply that you see in the South. And that's where you're seeing the most price appreciation as well.
Yep, that makes sense. Not as many builders flock to those areas. All right, so the appreciation rate of investor properties was about 1.7% year over year. At least that's what I see in the report. Is that right?
Yes, that's right. So what we saw is that in Q2, the typical investor was earning just south of $200,000 in capital gains when they were selling their home, and that is up about 1.7% year over year. So there is growth that is happening, but it is pretty small.
Yeah, compared to 2021 when it was 30%, but that's not normal. That was an anomaly.
Yeah. But as an investor, I think you're also thinking about what you can do with your money in other asset classes, obviously. And so in the current environment, there are a lot of, you have to think about like kind of what is the context for what else to be putting your money.
Sure, sure. Yeah, it's funny. In our pro formas, I used to put 2 to 3% appreciation. Anyway, so to me, that's kind of normal considering that you still have somebody paying off your debt. You still have hopefully cash flow on the property. There's and tax benefits. So there's other ways to make money in real estate besides just the appreciation. And when you consider you're probably just putting 20% down, but still making that 1.7% on the whole value of the property, it's more. It's more than a 1.7% return.
Yeah, for sure. And also, I think, it is a little bit hard to, as always, you don't have certainty about where price appreciation is going in the housing market. We saw sort of a big slowdown in home price appreciation in the first half of this year. But as we're looking forward, it's becoming a little bit less clear that deceleration in price appreciation will continue. It does seem like a lot of sellers are pulling back now as they're understanding what the dynamics of the market is. And there are some metrics that do seem to indicate that price appreciation might be reaccelerating again. I think it's very early days, so I wouldn't put a lot on those like few data points yet, but just want to highlight that I think there is a lot of uncertainty about where price appreciation is going.
Yeah, absolutely. I mean, Logan Mudashami, Housing Wire says the closer we get to, 6% on mortgage rates, and we are inching towards it, that there would be potentially another boom of people who would be able to afford. So we shall see. Boy, it's hard to make predictions these days. So what do you see as the biggest headwinds for investors? Mainly higher home prices and the high interest rate environment?
I think that, it's unfortunately not like nothing so like super novel necessarily, but really I think the rate environment is really just the thing. It's the same old story. We've been living 3 years now,
Yeah.
but the rate environment continues to be just the most challenging thing. And as always, as we've been saying, there's just a lot of economic uncertainty. It feels like every year we're saying, wow, there is so much economic uncertainty. And then somehow next year there's more economic uncertainty.
Right.
So I'm not sure how we keep managing to top ourselves, but the economy is at this sort of inflection point right now. And this is what the Fed is dealing with, where it feels like we could really slow down. Maybe we're at risk of a recession, and not just to kind of like throw that scary word out there, but the labor market is kind of falling apart a little bit right now. But at the same time, we have inflation is slowly ticking up in the background. Not clear how scary of a threat that is. So the Fed can really go in one of two directions. They have some, a very kind of ambiguous choice ahead of them. But it is also the case that rates could really fall pretty significantly over the next while, but it doesn't have to. We could also sort of just stay in this holding pattern. It's just very hard to have any certainty about the direction of that right now.
Right. Yeah, because it is confusing. It's this stagflation kind of situation where growth is slowing, but inflation is growing or inching up. Do you think, given the latest jobs report and inflation report, that the Fed would still consider cutting rates in September?
Well, I think the Fed is definitely cutting next week. I think that is pretty much guaranteed at this point. If you're looking at what's going on in bond market pricing, the debate is really between, are they going to cut 25 basis points or 50 basis points? I feel pretty confident that they're going to do a 25 basis point cut. I don't think that there's really anything to justify a 50 basis point cut right now. So, I think that's pretty much baked in. The market is also expecting another rate cut in October and then another one in December. These are all fully priced in at this point, right? And that's why mortgage rates have gotten so low, is because the market is expecting these rate cuts to happen. It does seem like right now that the data justifies having these 3 consecutive cuts from the Fed. But it is true that there's still a lot of uncertainty about how quickly this sort of weakness in the labor market will accelerate. Because when economic conditions change like this, sometimes they just happen really, really quickly, where all of a sudden you realize, oh my gosh, there's nothing underneath, and you just kind of like fall. A lot of economists are calling this like a Wile E. Coyote moment. You're like running off the cliff, you don't even realize you don't have any support anymore, and then boom. It's not really clear we're like at a moment like that, because the data, unfortunately, can revise. And when it revises, sometimes, it paints a different picture of what's happening, right? And that's why the Fed does such a hard job. It's also the case that as the Fed is communicating that they're going to be doing these rate cuts, that actually offers support to the economy. So when the Fed is saying, look, we are really going to be cutting in the next few months, that means that companies might start to feel more confident about hiring again. Maybe they don't feel like they have to, do a planned layoff or something like that. And that just by itself can actually start to strengthen the economy. And that could put us back on solid footing again. So that's why I'm saying we might be at risk of a recession, which would lead to lower rates. But it doesn't really necessarily mean that we're headed towards one, because there are things that the Fed is actually doing to try to prevent that from happening.
Whew, good stuff. All right. Well, thank you so much for joining me here and sharing your wisdom here on The Real Wealth Show.
Of course. Thanks so much for having me today.
And thank you for joining me here on The Real Wealth Show. Be sure to subscribe so you never miss an episode. I'm Kathy Fettke. This is The Real Wealth Show, and we'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.